Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, January 14th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to start off with the weekly performance for the Dow, the S&P 500, and the triple Qs, just to give us a starting place. And we can see here for the week that the Dow was down 89 basis points, 0.89%. The S&P 500 was down 30 basis points, and the triple Qs were actually positive for the week, even though they've been very volatile. Now, before we move on to the chart, though, let's just take a look at the year to date to get a little bit more perspective, and then the charts will make even more sense. So the Dow, and this is so far for 2022, first couple weeks of trading here, the Dow is down 1.18% so far this year. The S&P 500 down 2.17%, and the triple Qs down 4.41% so far in 2022. Now, this first chart that we're going to look at goes back to the beginning of November. So we've got November, December of last year, and then the first 2 weeks of trading for 2022. This is a daily candlestick chart of the S&P 500. So each candlestick does represent 1 day of trading. We have a few horizontal blue lines, 4,500 at the lower end here. We have 4,600 line and then 4,700 to give us some perspective. Now, let's focus on the last 5 days of trading to start with, and then we'll kind of pull back and talk about the big picture, and then we'll move to an hourly chart here in just a minute. But here on Monday, you can see on Monday the 10th, we had a really volatile day after a whole week of selling basically last week, right? So we started off the week really and hit the lows of the week right here on Monday the 10th. We hit our lows of 45.8224 right there, and then we were able to get back above this 4,700 line, which has been a really important support and resistance area since clear back on November 5th, and we'll talk more about that here in just a minute. And then really Thursday, right? Yesterday was really the bad day. And brought us back down, and it was looking pretty ugly earlier today, but we can actually see that Friday, the 14th here, was slightly positive. We were up 8 basis points for today, but again, as we know, for the week, we were down 30 basis points on the S&P 500. So all in, a really volatile week, but the fact that we were only down 30 basis points, it's good news, right, so far. And the other thing I think is super important here, guys, on this chart is where we're at right now. We started really the first week of November right there. So we really haven't made any progress, right? No appreciable progress for over 2 months, almost 2.5 months on the S&P 500, but we've traveled a long distance, right? We're kind of having a rolling correction here, which I think could be good news in that, instead of just going straight down, right, as a lot of people might imagine, we're letting some air out of the market a little bit at a time here and going sideways. So I think this is one possible scenario that we're dealing with here. Only time will tell, but it sure looks that way, right? We're getting this kind of sideways correction, a lot of stuff selling off and then going higher. And the other thing I like about what I'm seeing in the charts here is we're getting a series of higher lows. Generally, that's a good thing. So we can see here on December 3rd that we pulled back to 44.9512 right there. Now, that's the first time in months, right? This chart only goes back to the 1st of November, but you can clearly see that that is the only day since the beginning of November, if not before, but we're not going to look at that right now, that we've had any trading below 4,500 right there on the 3rd of December. And then the next time we pulled back, a slightly higher low was on the 20th of December at 45.3110. And then obviously this Monday, a slightly higher low where we pulled back to 45.8224, right? But you can clearly see that all of the trading since the 1st of November has been between 4,600, this blue line here, and 4,700 here, with some trading up to the 4,800 plus level. And with that said, our all-times, just we have this before we move on to the next chart, the all-time daily closing high so far on the S&P 500 is right here. Now, we can clearly see we've had some trading above that level, and we'll talk about that here in just a minute. But the all-time daily closing highs so far on the S&P 500, 47.9656 on January 3rd. And then the very next day, we hit our all-time intraday high, ATIDH. I just abbreviated that. 48.1862, and that was right here on Tuesday, the 4th of January. After on Monday, the 3rd, we hit the all-time daily closing high. We made a new intraday high on Tuesday, the 4th, at 48.1862 before rolling over and pulling back and, again, pulling all the way back to this 45.8224 level. But the good news is, right, we didn't finish at the lows of the week. We kind of finished in the middle of the trading for the week. That's a good thing. And we're smack dab in the middle of this 4,600 to 4,700 trading range. Again, we closed at 46.6285. So, as you can see, we're pretty much dead center, right, between 4,600 and 4,700. So as long as we stay in this window, then we probably don't have a ton to worry about. But before we move on to the next chart, the hourly chart, if over the next couple of weeks we start to see daily and then weekly closes below 4,600, that's not going to be a good thing because you can clearly see that there's only been a few days of trading, especially a few days where we've closed since the beginning of November, a few days where we've closed below 4,600. And we haven't had one daily close in months below 4,500. So, anything below 4,500 would definitely be a problem. But as long as we stay above 4,600, we're probably going to be okay. Now, what we're looking at here is an hourly chart of the S&P 500 that goes back to the 27th of December. So the last week in December and then all of January so far. And you can see where we got up to this 4,800 level, right? We just kind of looked at that right here. But we got up to this 4,800 level, and you can see exactly, we get up to these round numbers. And I've taught, if you're newer to the channel, guys, this is something I've been talking about for years. Round numbers, and this goes back well over a century. Okay, it's been known that round numbers on stocks, on indices, whatever, when you hit these round numbers, especially something ending in a 00, those areas tend to be support and resistance areas, and that's, you can see it on 4,700, 4,600, 4,800, and you can clearly see we got up to this area, right, and we just started kind of hitting our head, so to speak, on 4,800. We've had a few hours of trading above 4,800, but that's it, right? Just a few hours, only a couple of hours where we've closed above 4,800, and this is in the entire history of this index. And then you can see that 48.1862 intraday high that we made on Tuesday, January 4th, and then we rolled over and pulled back again to 45.8224 right here on Monday. And then you can see we climbed, very nicely, right? Monday, Tuesday, Wednesday, and then we had more Fed commentary, right? I believe it was the Fed speaking in front of the Senate, and just the talk of raising interest rates and tapering the bond buying. The market doesn't like that, and individuals and algorithms, because keep in mind, a ton of the trading, over 70% of all trading in the stock market now is done by algorithms. So that verbiage gets picked up, and you get this selling. So it was looking pretty ugly today. Most of the day we traded below this dotted blue line, which is where we closed yesterday. So that dotted blue line on this chart would anything below that is negative, and you can see most of the day we were negative. And then the very last hour of trading, we were able to eke out an 8 basis point gain here on Friday the 14th. So, very volatile couple of weeks here, guys, very volatile couple of months. But the good news is, that we're trading kind of in a sideways trading pattern, with trading from anywhere from 4,500 all the way to about 4,820, right, over the last couple of months. But we're not just rolling over and going straight down. Now, before we wrap this up, I want to point out something here. Guys, it's not just stocks selling off over the last couple of weeks, all right? High-quality bonds, look at this. This is just today. These are one-day returns. The 7 to 10-year ETF, the IEF, right? That's the ticker symbol for that 7 to 10-year Treasury ETF, down 69 basis points today. The 3 to 7-year, the shorter duration, down 38 basis points. And the TLT, the longer duration Treasury ETF, down 1.51%, guys. That's just today, all right? And then for the week, not too bad, right? But down 14 basis points on the 7 to 10 year. We'll just focus on that here for a second. I just want to make a point here that, anybody that's an asset allocator, I mean, look at this. You're down 2.10% year to date on the 7 to 10 year ETF, and year to date, you're down 2.17% on the S&P 500. All right. So think about how volatile, right, the markets have felt. You're down 2.17% on equities. You're down 2.10 on the bonds. All right. So, these high quality bonds, guys, are not working anymore to offset equity risk. And so, it's going to take a different approach to investing going forward to make money, especially if you've been an asset allocator, right, having a 60, 40, 70, 30 type portfolio for the last 10, 20, 30, 40 years, it's probably not going to work very well going forward, guys, that traditional asset allocation portfolio. Let me ask you a few questions. Do you manage any of your own money, including in your 401k or your IRA? Have you ever found yourself out of sync with the market, underexposed when the market is rising, or overexposed when the market is declining? If you answered yes to any of these questions, please pay close attention to the balance of this video, because it could be worth a lot of money to you going forward. Do you have exposure to the S&P 500 or other large cap U.S. equities? Would you like the opportunity to increase your upside capture, decrease your downside capture, improve your risk return profile, and have the ability to sidestep major market downturns? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Would you like the advantage of knowing when it's generally safest and most profitable to be in equities, and when it's most dangerous and generally least profitable to be in equities? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Want more charts? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com, and I will also leave a link to this site in the description box below this video. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from Rich A. from Ohio. Hi, Rodney. I want to thank you for creating Simple Market Signals and making it available to the average investor like myself. I work hard for the money that I invest, and I want to try to get the best return for my investment. Like a lot of people, though, I just don't have the time to watch the markets closely, and have been blindsided a few times in the past by market moves I didn't see coming. Needless to say, if I could have avoided those downturns, I would be much further ahead financially. This is where Simple Market Signals comes in. It takes complex market data and distills it down into an easy-to-use tool that anyone can use to see where the markets have been and are likely to go. It is sort of like a barometer that a weather forecaster uses, only easier to use. I like the fact that I get weekly updates from Simple Market Signals and also get updates anytime there are important changes in the markets. Your emails are succinct and to the point, and the signals are easy to understand. Depending on how much time I have, I can quickly scan the main points that Simple Market Signals gives me or do a deeper dive and read about the various market sectors and their performance outlook. Either way, I get the timely and important information I need. Thank you again for doing this and keep up the good work. Again, that's from Rich A. from Ohio. Rich, thank you so much for the feedback. I really appreciate that. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice. But this is the feedback that SC from Florida gave me, so I appreciate this. So again, SC writes that Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well-off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the questions. So I produced it just as he wrote it. So the first question, what do you like best about Simple Market Signals? What JV said was, one of the things I like best about Simple Market Signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about Simple Market Signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has Simple Market Signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from Simple Market Signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com, and I will also leave a link to this site in the description box below this video.